So let me think about these ways of addressing debt problems and apply them to the situation of the Eurozone. First of all, what's the ideal way in which you can get yourself out of your debt problems? The ideal way in which you can get yourself out of your debt problem is through high economic growth, because high economic growth can heal most wounds, especially debt wounds. If your debt of the government or the private sector or the banks or individuals is too much compared to the GDP of the country, output or income, if the GDP or income rises fast enough, faster than the numerator, of course, those debt ratio to income and GDP are going to fall over time, and therefore your debt is going to become sustainable. So the best way to resolve too much debt problem is going to be having high economic growth. Now the question is, can we expect high economic growth in the Eurozone and the peripheral Eurozone or not? And as I'll point out, there are a number of challenges. The first point is that potential growth in the periphery of the Eurozone has been low for two reasons. One, there is aging of population. Population tends to fall, and everything else equal, potential growth is lower, where there are countries that have falling population. That's one constraint. The second thing is that the lack of structural reform so far has implied that productivity growth in the periphery of the Eurozone has been relatively weak, and the total growth rate is, of course, is the sum of productivity and labor growth. So both of them are growing very weakly. So those are the challenges to increasing growth. Third point, because there is now this burden of a large stock of private and public debt, as the book by Reinhardt and Rogoff suggests, this time is not different. Whenever you get out of a balance sheet recession or financial crisis where there is too much debt, growth is going to be weak for a number of years because you have to save more, spend less, and that implies slow economic growth until you clean up and you improve your balance sheets. So this time, unfortunately, is not different in the US, in Japan, in the Eurozone, and the economic recovery in most advanced economies has been below trend, anemic, with high and still rising unemployment rate. Fourth point, the right thing to do to increase potential and actual growth, of course, is structural reforms. Structural reforms that increase productivity growth, that increase over time potential growth, and therefore reduce your debt problems and make them more sustainable. So, of course, that's the right solution. And any one of these EU IMF programs, in addition to fiscal austerity, whether it's Greece or Ireland or Portugal, emphasize the role of structural reform. Now, I'm all in favor of structural reform, and unless the country is going to do structural reform, over time economic growth is going to remain stagnant. But there is one important caveat that affects growth in the short run. In the short run, unfortunately, structural reforms have a potentially negative effect on economic growth, and the positive effects on it occur only over time. Why? Doing structural reform implies to fire workers that are unproductive in the private or the public sector. It implies to shut down firms that are losing money, that are unprofitable. It means to reduce the amount of capital and labor from declining sector that are declining and moving capital and labor to emerging sector in which the country has comparative advantage. That's how you do it. It means doing reforms of regulation and other things that eventually lead to higher productivity growth. For example, it took Germany more than 10 years of structural reform until they restored high economic growth. In the beginning, there was actually the pain of those structural reforms. That's why actually the political economy of structural reform is difficult, because you have short-term pain and medium-term benefits, and if you are a politician that has to be elected every 2 or 3 or 4 years, it's very hard to implement those structural reforms in the short run, because they have this economic cost. So that's a necessary part of the solution, but it's hard to implement. So that's the constraint, that in the short run, paradoxically, structural reform make growth worse. The fifth constraint to growth is, in order to return to growth, you have to restore your external export competitiveness. You have to reduce your trade and current account deficit and go to a surplus. But in order to achieve that restoration of competitiveness, you need either a nominal or a real depreciation of your currency that makes export cheaper and imports more expensive. That's what happened in many traditional financial crises, like in Asia or Latin America. There was a movement from fixed to flexible exchange rates, the currency devalued, and in a matter of 12 months, the country went from a 10% current account deficit to a large surplus. And that surplus is a stimulus to economic growth because it means your net exports are growing. Unfortunately, this option of moving to a flexible exchange rate in the Eurozone is not available because the Eurozone members are members of a monetary union where there is one currency and the national currencies were eliminated over a decade ago. Not only that, but think about how a real depreciation could occur within the context of a monetary union like the Eurozone. One option would be for the value of the euro to depreciate a lot relative to US dollar and other currencies. Now, what's happening today is that the value of the euro not only is not weakening, but week after week is strengthening, in part because the European Central Bank has now decided to increase interest rates while the Fed is on hold. The euro during the Greek crisis had fallen from 150 to the dollar to below 120, now is back to 150 and rising. Now, Germany, that is uber competitive and very efficient and productive, can live with a euro at 140, even with a euro at 150. But Greece, Spain, Portugal, Ireland, Italy, that have lost competitiveness for a decade, need a much weaker euro. A euro even at 140 is painful, at 50 is extremely painful, and is going to hamper the restoration of economic growth in the periphery of the Eurozone. And therefore, the strengthening of the euro is a negative to restore competitiveness, and the weakening is not occurring. The second solution to restoring your competitiveness is to do the German way. That means accelerate structural reform, accelerate corporate restructuring, let wages grow less than productivity for many years, and if your wages grow less than productivity, over time, even if you cannot move your currency, your unit labor costs are going to be falling, your real exchange is going to depreciate, and your goods are going to become more competitive. But think of it. It took about 15 years for Germany of wages growing less than productivity to restore its own competitiveness. If Portugal or Spain or Greece start today, the costs are going to be in the short run. The benefits are going to occur only 3-5 years from now. Is that fast enough to restore economic growth? That's an open question. The third way in which you can restore your competitiveness, if you cannot move your exchange rate, and if you cannot increase productivity more than wages, then it's through painful deflation. If the price of your goods can fall relative to foreign goods, you can restore your competitiveness. You have to reduce wages, you have to reduce prices to restore your competitiveness. But the deflation route to a real depreciation leads to economic recession. Argentina tried the deflation route to a real depreciation, and after 3-4 years of ever-deepening deflation that led to an ever-deepening economic recession that became a depression, they gave up, they devalued and defaulted. So deflation as a source of real depreciation doesn't work because there is no social or political body can accept 5 years of deflation, 5 years of ever-deepening recession as a way of restoring your competitiveness. That was tried before, doesn't work. And as you have deflation, the real value of your debt goes higher, and your debt burden in the private and public sector becomes worse, and therefore deflation makes your debt problem even worse. So, as I pointed out, the fifth way to restore growth is to restore competitiveness, but there are all these major challenges to restoring competitiveness, unless by miracle the value of the euro were to sharply be reduced. Sixth point, to restore growth is critical, but to restore growth you need not only structural reform, you also need the macro policies that restore growth. And I would argue that the current policy of the European Central Bank that is raising interest rates too much, too fast, too soon is detrimental to the recovery of competitiveness and growth in the periphery of the Eurozone. Raising interest rates means lower economic growth. Raising interest rate means a stronger euro that means worse competitiveness. Raising interest rate means further damage to governments that have too much debt that have to finance. Raising interest rates is going to damage financial systems that are already strained in terms of their own liquidity. Therefore, in my view, the European Central Bank, by emphasizing the inflation objective and not giving enough emphasis to the restoration of economic growth, is going to be further damaging the restoration of growth and the competitiveness of the periphery of the Eurozone, and that's going to be damaging. 7 factors that may restore economic growth is that if the periphery of the Eurozone has to go through painful deleveraging, through painful fiscal austerity, to painful structural reforms, then the core of the Eurozone, starting with Germany, should have more of a fiscal stimulus, more of an increase in domestic demand to boost their own economic growth, and through trade channel boost also the economic growth of the periphery. And unfortunately, Germany has decided that they also have to do front-loaded and early fiscal austerity when Germany can wait for a while longer. The bond vigilantes have not woken up in Germany. Instead of raising taxes this year, I would cut taxes in Germany to boost disposable income, to boost consumption, to boost economic growth. That would help Germany, that would help the Eurozone, that would help Portugal and the periphery. That's not happening. So, first solution to a debt problem is growth, but as I pointed out, there are several reasons, at least 7 separate reasons, why the recovery of economic growth in the periphery of Eurozone is not going to occur anytime soon, unfortunately. So that route, unfortunately, is not going to be available anytime soon. Second solution to a debt problem. If you have too much debt, you can decide to save more to reduce your debt. If you consume less, in the private and public sector, if you save more, gradually over time you can reduce your debts. That's exactly one of the strategies. But think of it. If you do have a reduction of private consumption and an increase in private savings, you end up in what John Maynard Keynes referred to as the paradox of thrift. If suddenly all of us decide that we have too much debt and we stop consuming, we save more, consumption collapses, private demand collapses, the economy goes into a deeper recession or goes into a double-dip recession, and if a recession occurs, then as output falls, your debt in the private and public sector and your deficit become larger as a share of GDP because GDP is falling, and therefore that's not the solution. So having too much savings in the private sector, too much cutting consumption leads to this paradox of thrift. What about public savings, reducing government spending and increasing taxes and other revenues? You have a similar paradox of thrift because while on one side it's clear that if your deficit and debt in the public sector is not sustainable, you have to reduce it, because if you do not reduce it, eventually you're going to hit a wall, there's going to be a fiscal train wreck, you're going to lose market access, so of course the debt has to be reduced, the deficit has to be reduced. But the recent study by the International Monetary Fund suggests that in the short run, fiscal austerity has a negative effect on growth. Raising taxes, raising other revenues, reducing government spending, even inefficient and unproductive government spending, reducing subsidies to the private sector, reducing unemployment benefits and other transfer payments, they all imply less spending, less disposable income, because you're raising taxes and cutting subsidy and transfer, and imply less demand by the public sector, less demand by the private sector, and it makes the recession worse. So one of the critical issues when you do fiscal austerity is to make sure that this fiscal austerity is not front-loaded, that you do it gradually over time, because the more is front-loaded rather than back-loaded, the more there is a chance that you're going to have a fall in output, and that fall in output is going to again lead to an unsustainable debt and deficit. That was exactly the kind of a debt trap that Argentina fell in 10 years ago. They had a large budget deficit, they kept on raising taxes, they kept on cutting spending, the recession became worse, output kept on falling, and achieving the stabilization of debt and deficit became mission impossible, because with a free fall of output, of course, you can cut as much as you want your deficit, but then it's going to go higher as a share of GDP if GDP is in free fall. So you have a paradox of thrift both in the private sector and in the public sector. So you need to save more in the private and public sector. If you do it too much, too fast, too soon, that's a danger. And I would say that the IMF has learned that lesson, because the recently announced today program that has been agreed between the IMF, the EU, ECB, and the Portuguese implies that the reduction of the budget deficit in Portugal is going to be more gradual. The objective of reaching 3% of GDP budget deficit has been pushed by 2012, 2013, I would have said that probably to make it even more viable, moving it by an extra year, 2014, might have been beneficial. But that's not what has been agreed. But at least is a move in the right direction. But there is still an open question in Portugal, in Ireland, in Greece, of whether this fiscal consolidation is going to crowd in growth, how long it's going to take to crowd in growth, and whether instead the crowding out effect of less demand and less disposable income are going to be making the recession worse, and for how longer. In the case of the IMF program, it's expected this year and next year there's going to be still a recession in Portugal, hopefully a recovery in 2013. The question is whether the social and political system can accept 3 or more years of a continued recession. That's an open question. So, second solution, as I said, to a debt problem is to save more to reduce your debt. That has all the pitfalls that we just discussed. The third solution to a debt problem, of course, is inflation. Inflation could wipe out the real value of private and public debt and can avoid the kind of debt deflation that occur when you have, for example, a housing bubble that went bust. Now, some countries have the option, if they want to do so, of monetizing their fiscal deficit. The United States, the United Kingdom, and Japan. In the case of the Eurozone, unfortunately or fortunately, depending on your views, the ECB is not going to monetize the budget deficits of the countries in the Eurozone, because the mandate of the ECB is essentially price stability, to not bail out country and not monetize deficits, and the ECB on monetary policy is more hawkish than the BOJ, Bank of Japan, the Federal Reserve, or the Bank of England. So either a country like Greece is able to restore its debt sustainability and deficit reduction by raising traditional taxes and cutting spending, or if that option is not going to be viable, then there is not going to be any chance that the ECB is going to monetize it. Therefore, a restructuring of debt is going to become unavoidable. So the Europeans do not have the option of doing the monetization of the deficit and using the inflation tax. And certainly, if anything, not only the ECB is not monetizing the deficit, but by having an early tightening of monetary policy and raising rates and strengthening the euro, as I pointed out, makes the growth and competitiveness problem and the fiscal and the financial problem at the periphery worse than otherwise. Granted, the ECB is providing some liquidity support to the banking system, to its own non-traditional liquidity support, but that's not sufficient enough. Easier monetary policy or not tightening will be necessary. That leads me to my fourth point. If you cannot grow yourself out of your debt problems, if you cannot save yourself out of your debt problems, and if you cannot inflate yourself out of your debt problems, the only other solution that is available, if all the other ones are not available, is the one of an orderly restructuring of your debt. As I pointed out, that fourth solution is not unavoidable if countries, through structural reform and fiscal austerity, are able to implement them. If they're able to restore their economic growth, then they avoid that choice that is always difficult, dangerous, and subject to potential collateral damage for the real economy, for the financial system, through contagion and other types of effect. But if those other solutions do not work, if they're tried, if they're implemented, and growth fails to recover, and there's a chance, as I pointed out, that fiscal austerity and structural reform make the recession worse, then orderly and market-oriented debt restructuring can occur and have been implemented in the past. You don't need to default on your public debt. You don't need to default on your private liabilities. Countries like Uruguay, like Ukraine, like Pakistan, like Dominican Republic, and others have done in the past orderly reprofiling of their public debt in a way that was not disorderly, that avoided contagion, and has avoided damaging significantly the financial system. It's not an ideal solution, but if else doesn't work, then that's what has to happen. So if you cannot grow or save or inflate yourself out of your debt problem, you have to restructure them, reduce them, or in some cases, you can convert some of that debt into equity. That's what is being done in the corporate sector.